Okay, let's talk about financial statement analysis. We covered this in managerial accounting, but we're going to cover it again here because it's also very important in corporate finance. So we're going to look at the ratios and the different size balance sheets and so on. The comparison of balance sheets and income statements again, as we did in managerial finance. We're not going to go as deep into it as we did in managerial accounting with regard to common size balance sheets, but we are going to talk about a few other ratios and other equations that we didn't cover in managerial accounting. So it's not going to be a complete review of everything. We're going to hit the highlights that we previously covered, but we're also going to cover some new material here. So don't click past this too fast, because this is very important in corporate finance. Okay, so in financial statement analysis, we have to develop a good working knowledge of financial statements. Making financial statements useful is one finance role, or one role of finance. So we do things like ratios and common size financial statements. They're very common techniques to be able to compare two different types of firms, or two different firms of different size and different complexity and so on. So let's look at just the first step, which is common financial statements. Common financial statements, there's two types. The balance sheets, of course, compute all accounts as a percentage of total assets. Common size income statements compute all items as a percentage of sales. So we have standardized items to make it easier to compare financial information, particularly as a company grows. They're also useful for comparing companies of different sizes, particularly within one particular industry. And of course, you may round percentages in common size financial statements and end up with just slightly off of 100% because you're rounding error, or you're rounding off a little bit, but that's okay. So what we're looking for here is a comparison. So to remind you that why a ratio is such a wonderful comparison is because if I have a company that earns $100 million in profit and a company that earns has $100 million in sales, and a company has $10 million in sales, well, comparing them apples to apples is going to be very difficult in a numbers or a net income basis, but I can look at them with regard to how profitable they are as a percentage of their sales. The same thing's true in a balance sheet. If you look at a balance sheet, how much debt do you have? Well, a debt to equity ratio would tell you the leverage of a firm, whether it was a company that had $100 billion in debt, or if it had $1 billion in debt. It wouldn't matter if I could look at how much leverage it has. Debt to equity ratio would tell you that how much leverage it has. So you can see that ratios allow comparisons with different size firms. It's very, very common to have these ratios. So in these common size financial statements, we've got an example here of a balance sheet and a common size balance sheet. As you can see, the regular balance sheet just is the common numbers and that we would expect, and the one on the right, the common size balance sheet, is percentages. And you can see that the percentages here are how much of total assets is cash, for example. They had 2.5% in 2013. They have 2.7% of cash in 2014, so it has increased to 0.2%. Net plant and equipment has been down 0.7%. You can go through the liabilities and look at those. So you can see that the advantage in looking at common size balance sheets, or you can get a quick comparison of last year versus this year, what's changing and what's moving forward and how much it's moving. Obviously the percentages are going to tell you how much it's moving much quicker than trying to look at different numbers and do it in your head. So a common size balance sheet in this case would be very helpful. In addition to that, we can look at the income statement, and a common size income statement is going to roll everything off as a percentage of sales. So we can see sales at 100% off the top, and then after that is the cost of goods sold. The depreciation is 58%. So our margin, our gross margin here is 100% minus 58% is 42%, or in this case it'd be 41.8% if you want to do the math more precisely. So we're making 41% gross margin, which is pretty good. After that, we've got depreciation, interest before taxes, interest paid, taxable income, interest, and we get to net income. Net income is our profitability, and we're making 15.7% in our bottom line. So 15% isn't bad, and so we start thinking in terms of percentages. We can start comparing to other companies. Who else is earning 15.7%? Where else could I invest my money maybe? Or what are we looking to beat for the next quarter, for the next month, the next quarter, the next year, if we're earning 15.7% net income right now. So the percentages will give you a really good idea of comparisons to not only over time, but to other companies and to other industries. And of course, historical averages also are something you would want to look at percentages wise, because the different size firms and the different industries that they're in are going to be completely different over time. So we've looked at two different types of common size statements. The next thing we're going to be looking at are the financial ratios. And there's a whole bunch of financial ratios, as you remember. We will go over those in the next video.